Good evening, ladies and gentlemen, and welcome to this exclusive webinar on equity markets and some of our equity strategies. Let me introduce our speaker and a very senior and a very popular fund manager from the panel of HSBC. We welcome Chinu Gupta, Fund Manager Equities from HSBC Mutual Fund. Chinu, I'll just read out your background, Chinu, although I know this is now becoming very embarrassing because I think everybody knows you and you've been a very, very regular speaker on this panel. But for those of you who are joining for the first time, Chinu is the equity fund manager at HSBC Asset Management India and brings with her around 20 years of rich investing experience. She joined HSBC as part of the L&T investment management team. And at HSBC Mutual Fund, Chinu manages four funds. She manages the HSBC Large and Mid Cap Fund, the HSBC Mid Cap Fund, the HSBC Multi Asset Allocation Fund, and also the HSBC Equity Savings Fund. So it's a good mix of certain funds focusing on market caps as well as some of the hybrid strategies that we have. Prior to that, Chinu worked with Canada Robeco AMC. She was also associated with the Tata AI Life Insurance as an equity fund manager, ING Investment Manager as senior research analyst, and UTI Mutual Fund as an analyst, where I think Chinu started her equity career. Educational background: Chinu is a CFA charter holder USA, and she completed her postgraduate diploma in business management from SP Jain, Mumbai, where also she was a gold medalist in her finance specialization. Chinu is also a BE Information Technology from Vesit Mumbai University. So with that background and a very, very credible career, let me welcome Chinu. And Chinu, welcome to the webinar.
Yeah, sure, Rajat. Thanks for that very elaborate introduction.
I know, this is now a protocol. Everybody knows you, and you met so many of our partners who are there on the call in person as well during our travels. But every time we have new partners and new colleagues joining in, so I think they need to know who you are once again. But Chino, we'll do it slightly differently this time because most of the times when you and I have been on a webinar, it's usually you show us a presentation and then there are questions coming in from audience, and then I also pose you some questions. So we thought we'll do it slightly in a differentiated manner this time. Let's make it conversational, right?
Yeah.
So there are lots of queries, as always, which we receive from our partners. The invite goes to our partners almost 10, 15 days in advance. And there are lots of messages which come to us that this is what we want to ask Chinu, and we want Chinu to share our views. So all our partners and colleagues on the call, one small request. We have some questions for Chinu, which are there, and Chinu has some data to answer and substantiate those questions and our answers. I can also request you to keep typing in your questions at the Q&A tab. There is a Q&A tab you can see at the bottom of Zoom. So please keep typing in your questions, and we will have some time in the end, and we would request Chinu to answer some of your questions. Okay, so with that, Chinu, lots and lots for you to answer today. And let us begin with the burning topic. And the burning topic is this time not the small picture, but the big picture. Okay. So before we move on to funds and strategies, I think it's been a long period. I started by saying now we are in the 6th month. So almost half the year has gone into geopolitical tensions and wars. We saw a period of volatility. Now we are seeing a period of consolidation with obviously the VIX and the volatility index now not jumping the way it was earlier. Today, if I have to ask you, where do you see the Indian equity markets in terms of three things: fundamentals, valuations, and earnings? Are we at a point today where investors should be increasing their equity exposure, or should they continue to remain cautious the way some of them have remained in the last 6 months?
Yeah, sure, Rajat. I think that is a very burning and relevant question, top of everybody's mind. And to start off, let me tell you the journey in this last 1 year has been extremely volatile, right? If you all remember, last August was the time when Trump imposed almost 50% tariff on India, and we all were battling through it. That was something new for us. And the year has progressed. So first half of the year, we battled with the tariffs and trade deals. And if that was not enough, then came the US-Iran conflict immediately following it. So geopolitically, it's been one of the most volatile years. And I must say that even for macro, it was a very sensitive year because when you're looking at some of the broader things, like what happens to the deficit that India is facing, what happens to our currency, what happens to balance of payment. I think all these things were very delicately there when crude was just inching up at the beginning of this war. And
Yeah.
we saw that crude was going towards $100 per barrel plus. So those were extremely difficult times. Not that today is easy. We are still there in middle of conflict, but I think every conflict you see the peak volatility in the beginning, and then later on it just drags on, putting some pressure. But by this time, most of the people have understood how to manage things. And even if I talk about currency, 10% depreciation in a year, I think this is one of the highest that we've seen. So tough year, but yeah, let me show you some other interesting data points.
Hmm. Yeah, we look forward to seeing your slides because
Yeah,
they are a treasure of data.
yeah, let's see. I think, so these are the broad data points that I was mentioning, that
Hmm.
despite this being such a difficult year, I think what we could see is our broad macro indicators did not turn negative. Look
Yeah.
at all this data, right from two-wheeler sales to GST numbers to India core sector growth. None of these data is showing you any kind of concern, your IIP growth, which is
Hmm.
in fact very encouraging. If in such a delicate year where everything is going topsy-turvy, this could be managed, then I think it's giving you an indication of economy bottoming out.
Hmm.
And look at this again, credit growth. We all knew where
Yeah.
the credit growth had tanked, and now where it's inched up.
Wow.
So again, this is quite encouraging. And last is the nominal GDP growth. Last year, we heard ample noises because inflation was very low. So added to GDP, these numbers were like sub 10%, which is something not doable for a developing economy like India. Now, as this year starts, we are back on the journey of
Hmm.
increasing GDP, nominal GDP growth.
Yeah.
So, on and all, if I look at this picture and add that question where you asked that, is this the right time? I
Hmm.
believe this macro indicators, which is kind of improving, added to the fact that 2 years we've not seen any substantial return from the market, it makes a good background for investors either to continue staying invested, or if there is any input that they can have in their kitty, it's a good time to add to the funds in the market.
Lovely. And we just love the way you kind of articulate data and relate it to the macro picture. These variables are something which people would ordinarily miss or yawn over when they read in publications and newspapers. But the way you've presented it as trends, Chinu, thank you so much for this. Okay, that makes me come to the second question. And the second question is, and this is what we have been taught and we have learned all this while, that over the long term, prices follow profits. I still remember this, right, from my early days. So when I'm earnings in Chino, earnings will ultimately drive the next leg of the market. I've heard you say this many, many times over the years. Now, what is your assessment of the current financial year 2027 earnings trajectory? What is the direction of travel? And if you're talking about that, please also tell us about which sectors are likely to see the strongest earnings upgrades and where are the expectations still too high? Where do you find that, the earnings are probably higher than where they should be?
Okay, no, decent question. For the earnings, I think this is the
Hmm.
kind of picture that I really wanted to talk about.
Okay.
And taking a step back, not just to the bad years, but like right from post-COVID, we had seen a very strong trajectory for our corporate earnings.
Hmm.
Normally, this 28% kind of growth that we had seen, it's not sustainable, right? We all know that, but
Yeah.
somewhere I think when the environment is bullish, earnings are bullish, even your estimates start getting bullish, and that is what happened. So that sharp correction to sub 10%, I think that looked like a jerk, and that is what dampened sentiment as well. The good news is today, as we are talking, this Q1 FY27 earnings, I think almost 65% of the earnings are through. We are there with most of the earnings. And this is the quarter where we are already there with double digit earnings growth.
Hmm.
So we were talking about it last 3 4 months. We've been saying that earnings growth will come in double digit will come. And I think this is the quarter where we've seen healthy double digit, not just double digit. Earnings growth might end up anywhere between 15 to 20%, which could be very encouraging. Uh, Also, if you look at the chart below, this is another indicator which I think we observe closely. This is the
Yeah.
upgrade to downgrade. This tells you where the market is perched and where the companies are performing. If you look at these numbers, they've been close to one is like a good zone to be in, but we were coming off a very, very muted zone. You can see this point 2, point 3.
Mm.
numbers. But the good news again is this quarter is not complete, but where we are standing today,
Wow.
this ratio has inched up to 1.1. So what it's telling you is that when the environment is bad, your sentiments are bad, then your estimates automatically are lower. So the
Mm.
chances of the companies delivering on those beaten down estimate turns out to be higher. So this is where we are inching, and now let's see where do we end the quarter. You also asked a question, Rajat, which sectors we are seeing
Yeah.
positive estimates and not. I would say sectors like autos have really surprised positively.
Mm.
There was
Mm.
expectation of a lot of earnings pressure on them,
Yeah.
margin pressure, etc., in the quarter, but they have delivered well. Uh, Even sectors like cap goods, where the expectations were already high,
Mm.
earnings have come through. They've delivered on those expectations. And here, I think order inflow also stands in good stead. You have good visibility of how the earnings would come through. Now coming to two big sectors of the index, IT and financial, especially banks. IT first, yes, there has been some softness. We all know we are coming off that AI period. It's still going on. There is expectation of some bit of earnings softness, which is playing out in the earnings. So IT, I don't think anybody is building in higher than mid-single digit earnings growth for most of the companies. There will be a couple of exceptions. But if you go to other space like financial, which is the big space, you see two categories. NBFC is already delivering very good earnings growth. Your banks are almost at the fag end of lower earning growth. So this quarter will probably be the last quarter where banks will show single digit earnings growth. Next quarter onwards, even banks would join the double digit
Yeah.
earnings growth
Yeah.
trajectory. So I think overall, it's looking like a healthy place. And again, you asked a question, where are estimates higher? Then let me tell you, for a change, everybody is kind of in a very okayish zone. Nobody is bullish. So I don't think in any of the sector people are shooting out of whack.
Yeah.
Everywhere, I think expectations are very linear right now, if not bearish.
And I just want to stay on for ask request you to stay on this slide. I think this is a very interesting phase which you have highlighted in the upgrade downgrade ratio. You have an elliptical coloring in between Q1 of 2025 and Q1 of 2026, and this is exactly the time if I have to extrapolate the markets, the Sensex, the Nifty, the BSE 500. I think, Chinu, this will kind of superimpose. So very clearly, when you see the upgrade downgrade ratio fall to zero point 0.4 or zero point 0.3, that's probably the worst time of markets. And you see a recovery the moment it starts coming closer to 1. Yeah, very interesting observation. I've not seen this graph earlier, so thank you so much for enlightening us. So you've covered fundamentals, you've covered earnings. Now we come to the second side of the coin. As you say, if earnings and valuations go hand in hand. So let's talk about how pricey are certain segments of the market. So, I mean, this is now been going on for almost 1.5, 2 years. The battle between large caps or mid caps or small caps. So large caps today appear relatively more comfortable on valuations, while mid caps continue to be trading at a premium. Now that may be reality, that may be a perception, and which is why we have you to answer that. How are you thinking about the risk reward between across large, mid, and small cap today?
Yeah, I think Rajat well said, and this is nothing new. As in this debate, what you said between large, mid, and small, where are they on the valuation curve? This is not something that we are talking for the first time. And like maybe we can first focus on the right hand side where we are
Yeah.
talking about the 12-month forward PE. So
Hmm.
yes, large cap valuation extremely comfortable. 18.3 is like a very comfortable valuation where we are. Uh,
Yes.
this red line shows you Nifty 500. So it would be large cap dominated, again 20x. Come little above, there you see small cap valuation, 23x, and mid cap at 26x. So now the point is your valuation of small and mid obviously are looking higher than large cap. Now the
Hmm.
question to ask here is, are they justified, or again, it's like a bubble being formed? One
Yeah.
is you can look at this graph and you can look at the gap between the valuation. That itself shows you the kind of correction that you've seen in small and mid cap valuations is kind of higher, that we can see. Apart from that, let's come to the left hand side of the graph where I think this can come out in a lot more clarity. You will look at FY24, almost all indices are looking very healthy, very good earnings growth. But this is what happened in FY25 and 26. Suddenly, the earnings growth kind of came off.
Yeah.
The black line, which is the top 100 companies, earnings growth dropped to 12% and then even as low as 5%. Now, if you focus on the dark gray bar, which is the mid cap earnings growth, I think this resilience is what they are being rewarded for. Even in the years where earnings growth are very sharp, your mid caps earnings growth has been 20% and 15%. So, this is exactly, as I said, the resilience. And last is the small cap. Small cap, as known by its nature, expected to be volatile, and you can see that volatility. So 1 year they were 29%, then 4%, then 13%. So everywhere. And today, as we are talking, again, look at the expectation shooting up in small cap. A straight 34%. So as always, I'll put that caveat that we believe that earnings growth are picking up. Good thing is, even in large cap, there is expectation of earnings growth picking up. So it's a good space. At the same time, mid-cap companies have demonstrated good agility, ruggedness, and even in tough environment, the strength they've shown, I think that will always give them that premium valuation. Coming to small cap, there is this distinct thing which I kind of mentioned in quite a few calls that we have, where I say that small caps are very sensitive to economy at large. If the economy is delicate, macros are not perfect, your small caps earning growth can just tank in. Vice versa, if factors start turning positive, then your small cap numbers can easily shoot up. So they are the sensitive segment, and this is what you can see in these graphs. What we are saying, economy is bottoming out, things are looking like they are kind of improving. If that stays, and that if is important because as we said, we are in between of this tough geopolitical period. So that if will remain. But if that happens, then the earnings growth in small cap will be better. And hence, small cap, there are times they don't look good. There are times they look good. These are the times where earning growth are coming back. So small cap is also looking interesting. At the same time, I think mid cap now we are saying that they have moved to a zone where your large caps used to be a decade back.
Hmm.
Rugged, decent earnings growth 15-20%. So I think they are offering that combination. So to us, if you ask, preference will remain mid and small cap over large cap.
Lovely, lovely. And I think that is also kind of the structure of our assets in HSBC mutual fund. Chinu, you would know this better, but I've been reading about this for the last 3 years that I think more than on an average, more than 65% of our equity assets are skewed towards the SMIDs, the small and mid cap. So that actually shows that we are walking our talk. What you are saying here is actually seen in most of our equity AUM. Lovely. And Chinu, something which I want to ask you, these bars which you see here. So for example, if you look at the small cap expectation for this year, the PAT growth is supposed to be 34%. Is that correct? And next year, 25%. So if you compare this to the 23x multiple which we have, uh, I mean, it looks too good, right? So you can actually justify this even at a 28 or a 30x multiple if the earnings are as good as 34% or 25%.
Yeah, but ideally, Rajat, how I would say it, the usual rule of the thumb is look at earnings CAGR. When you
Yeah.
take a CAGR, you'll come at a number and then give a peg ratio to it. So I think that is what will work best.
Very insightful. Chinu, thank you for the valuation part. Let's move away a little bit from India because right now I've been hearing this for now almost more than a year, and you also kind of reminded us of the troubles which are over. You talked about the trade tariffs, which we had forgotten that this was eating into our returns and our mind share for so many months and so many quarters. So let's talk about some global issues now, Chino. Chino, there is a question around global factors, and which is very true that you can't say that India is not plugged in and is insulated. Global factors have been impacting market returns and portfolio returns in India. How are you assessing the impact of couple of these factors? I'll spell out a few important ones for you. There are hundreds of them, but let's, for the time being, focus on uh, in increasing order of importance to the Indian market. Let's talk about rates in the US, interest rates in the US, right? Let's talk about the global liquidity. So the flows which are coming out of US and other parts of the world. Thirdly, you can't forget oil is on the boil. It continues to be on the boil. Today, I believe somebody just told me it's again crossed 90. I've stopped checking oil for some time now. And obviously, the chances of another geopolitical risk coming up and all those things. So, what has been the impact on Indian markets, and how do you see FI flows into Indian equities, keeping this as an overbearing impact over the next 12 to 18 months?
Okay, interesting. So I think very important to talk about future is to glance at what has been happening,
Yeah.
because that lays the base. So this is the picture of equity, how it's been playing out now for several months. So FI flows on the left and domestic flows on the right, and you can see the picture clearly. It's been
Sorry to interrupt you, Chino. I think the second part of the question is related to the graph that you're showing on the right. So, in when you're talking about FIs, we would also want you to cover the domestic flows, especially SIPs, etc., because
okay.
you think that this will continue to be strong. You can please add some color on that as well.
Sure,
Thanks.
sure. So the point is now these markets have gotten used to no FI flows almost, right?
Mm,
Like, these
mm,
are several months at your glance that you can see, and no
yeah,
FI flows altogether.
sure.
So the point is, leave apart these FI flows. It's a domestic flows which have been sustaining the market now for quite some time.
Yeah.
Though I think towards the end you can see FI flows have started turning a tad positive. And this is where you're saying that now there is no further scope of outflows. Even we are not banking still on large amount of inflows. So at least the outflow should stop. And I think that point is good enough right now, the way we are positioned. So we are looking at some bit of inflows coming in purely because of FIs trying to reduce the underweight they have managed on India. Look at the AI related volatility that they have in other part of the portfolio. So then India can act like a hedge. So they may not be bullish on India, but definitely, some bit of underweight covering can happen. And this is what we are sensing with FI flows. Meanwhile, domestic inflows have been steady. Domestic investors have now understood that how do you take volatility in your stride. And I think this
Mm,
is working pretty well for them. We no longer call them jittery investors. They've become
oh,
very stable investors. And it looks like the SIP thing, which they've understood, that on correction, you don't panic. And you further add to it, I think we've seen ample evidence of it. So as of now, looks pretty healthy.
yeah. Perfect. That's interesting, and that's also a lot of conviction building. I think a lot of our partners would gain a lot of confidence from the last two bars, the ebbing bars in the FI chart, where you can see almost for now 43, 44 days continued flows coming in from an FI perspective. They had bid adieu to India 2 years ago, and now they are coming back slowly but surely. Okay, great. Thank you for elaborating on a lot of aspects. Uh, but a little bit on oil and rates, you want to just mention a little thing, something on
So
that?
oil, till the time it's below $100 per barrel, I think, Rajat, people will
Mm.
understand how to manage it. So that
Okay.
it's not a positive scenario. Obviously, 80 and below is positive. 80 to 100
Yeah.
is manageable. That is where we are today.
Manageable.
And above 100
Manageable.
is where then India have to start pulling all the plugs. So we did something
Mm.
like diesel price
Mm.
increase.
Yeah.
Government needs to step in
Mm.
to do various things. I think that scenario comes in.
Sure.
So right now we are in that middle scenario where companies have to take price hikes, manage those pressures, and that is what we see playing out now with the companies.
Fair point. Fair point. I think that's a good distinction that you've given at the level of oil. And I think where we are right now seems to be there should be no, hopefully, there should be no knee-jerk reaction from government and regulators. Okay, great. Let's hope for the best. You've covered most of the stuff. Okay. Now coming back to your or HSBC mutual fund style of investments. And before we go into managing investments and delivering returns, I think the important part is that risk and return are two sides of the same coin. So usually we find fund managers only talking about returns and performance. Before you talk about that, I want to ask you, what is your risk management approach, especially since your funds have a significant exposure to the mid and small segment?
Yeah, no, sure. So this is interesting, Rajat, and because this
Hmm.
is where all the partners at least need to understand where HSBC is
Yeah.
position and what we are trying to do. So one thing which we've clearly articulated is what is our approach. Our approach is that we will have funds which are very differentiated from benchmarks. So normally
Hmm.
you will find HSBC funds. This is not just the funds that I manage, but across HSBC all schemes,
That's
they
right.
tend to have a higher active share, which says that they are not benchmark. So you don't want to make a portfolio which is like a Me Too portfolio plus minus 1 2%, because end of that, if you start delivering returns, your returns will end up being closer to benchmark, and that is how market actually ends up shifting from active mutual funds to passive when your
Yeah.
returns are just kind of mirroring benchmarks. So what we say is we will take that active share, we will take those conviction bets. At the same time, it's not easy to do that, because then the management of risk becomes equally important. So how do we do that? I think that perspective is something very important. For us, risk management comes at three levels. It starts at the fund manager level. So at the fund manager level, the first thing you take a call on is how much of a particular stock you want to own. So that percentage weighting of your stock is important. Many a
Yeah.
times you will see that in particular schemes, the top holdings are like 7, 8,
Very, yeah,
9%.
very high. Yeah.
So dependence on few stocks can be very high. So controlling that stock dependence, I think that is one part of it.
Mm.
Other call that a fund manager takes is saying how much of liquidity risk you want to carry.
Yeah.
So usually you will see that if the stock is illiquid, even if our conviction is very high, we will restrict that weight to 1 to 2%, not more than that.
True.
Because
True.
in illiquid stocks, getting in and out can be really very tricky. So that is the other risk that is again managed at the fund manager level. So these two risks of stock specific in nature and liquidity risk is something that fund manager takes into cognizance. Then comes the next level, which is where you look at how much of overweight or underweight a sector you're going to.
Mm.
And this is where in the CIO overview, we discuss things, how much overweight or underweight you have on a sector, what is the overall positioning of the portfolio. So that's the second level. And then comes the third level, where the external risk management team comes in and they monitor some ratios every month.
Yes.
So they do a pre and post analysis. Pre is looking at the risk before it has figured out. So they manage the tracking error. They measure the
Mm.
tracking error of all of portfolios. So that gives you an idea of where the portfolio is positioned when it comes to risk which could unfold in future. And they also measure the attribution, which is the post analysis. After the fund
Yeah.
has performed, why it has outperformed or why it has underperformed. And I think I've always mentioned that at HSBC, you don't have to just answer why it has underperformed. Even if it has outperformed, you have to equally write that a para or a pager of why it has outperformed. So I think we do that management and understanding of the risk almost. This is done at the third level also every month. So these are the things that we measure, and with that, we are able to manage this high active share in the portfolios.
Absolutely.
So, this approach, yeah, is something that has worked well for us.
Absolutely. And it will continue to work, Chino, because like you said, in many other organizations and all, return is the only objective, but return coming at what cost and at what risk level. The adjustment of risk is something which is paramount in HBC. I've seen this being done by you. I've seen this being done by every fund manager. And as you rightly said, I think for the benefit of everybody in the call, there is a completely autonomous and independent entity called risk management at HSBC, which is not a part of the investment team, and they do their independent monitoring and mentoring and questioning of certain securities and the position sizing of those securities in the portfolio, like Chino mentioned. So that should give a lot of our partners a lot of hope and trust that there are multiple levels and checks and balances at HSBC. And Chino, I like the fact that if you have a stock which has performed exceedingly well, they also question you on that.
Yes.
Is heartening to know. Okay. I think enough said on risk management, global situations, and well as the over the market oversight and the overview. Now let's come to what you actually do, Chino. So we'll pick up three of your key funds. Okay, and these funds are pretty much prevalent in the market. We have a lot of investors, and some of our partners are also investing in them. HSBC Large and Mid Cap Fund, the HSBC Mid Cap Fund, and the HSBC Equity Savings Fund. So let's talk about these three, considering the time that we have today. Let me start with the HSBC Large and Mid Cap Fund. Yeah, so a new category, Chinu, came into existence in 2019 as an offshoot of the new categories which were announced by SEBI. I remember between 2018 and 19.
2018, yeah. Yeah.
Yeah. So, if you look at the large and mid cap fund, I know you've explained your philosophy. What is the core investment philosophy of this fund? And more importantly, how does the fund seek to balance the stability of large caps with the growth potential of mid caps?
So good question, Rajat, and maybe I'll use this question to explain my overall philosophy of
Yeah,
fund
yeah,
management and how I kind of try to have a mix across most of my schemes.
sure.
The percentages will vary how
Hmm,
I have them, but so the idea is when I'm looking at most of my portfolios and the stocks in my portfolio, I look at them through three lenses. The
sure.
first one being of stability or leaders. So you will see some names in the portfolio, their role is not to give differentiated returns or generate alpha. They are surely there in the portfolio for stability. So most of the times these are large cap names. So some of right now, if I talk about large private sector banks, I think we've stopped expecting outsized returns from them. We are expecting stability from them uh, because very good valuation, very good metrics. So they are there. Maybe some large pharma companies, very stable domestic oriented pharma companies. There's nothing differentiated you're expecting from them, but again, stability. So this is the kind of basket where I can decide that in a fund it can be 15%, say in a fund like mid cap, but in a large and mid, this proportion can go to 25%. So this is that stability kind of lens. The second one that you talk about is high growth or challenger companies.
Yeah.
Most of the time, these are few large cap companies, but most mid cap companies, because they are the companies who are kind of very agile and gaining market share. I think the key thing that you can observe is an output. As an input, there are several things. They have a different strategy, they have better products, better execution, they are more nimble. But as an output, if you have to see one thing is they end up gaining market share in whichever industry they are operating. This will not be an everlasting period. Usually, for a company, it lasts for some 5 to 6 years if they are doing their job well. And this is the time that you want to pick these companies. We call it inflection period for the companies. These are the high growth and challenger companies. Their role is to give compounding returns in the portfolio. So they are
Okay.
discovered stocks, nothing new about them. Industry knows about them, people know about them. But because they are executing things so well, they give you this compounding returns.
Mm.
The last window is something that takes most of our time, bandwidth, energy, and I think it's a very interesting window because most of the winners for the fund come from this window, which is the
Okay.
turnaround or the themes category. Now, here you're looking for some differentiated idea. And the earlier you are able to pick these ideas, the better alpha you end up generating for the fund. But this is also a category of hits and misses. So,
Yes.
because these are not proven stocks, many a times there is a thesis which is proposed by the management. You understand their strategy, you believe them, you take a certain position. If things go well, we kind of keep on adding to our conviction. If it goes really well, the stock actually ends up migrating from this turnaround category to high
High
growth
growth.
category. So that's
Correct.
like a pure success for the fund. So most of our top holdings in the fund end up being like this. If it doesn't go well, many a times the strategy is proposed and translating into action does not happen. So we follow it, every quarter to quarter, 6 months, 9 months. If we think things are not going as per what we expected, we start weaning off the weight in the funds. And if it's wrong, I think we can even exit those positions. So this, as I said, is a category of hits and misses, but a very interesting space to be in. So broadly, this is how we look at it, and one third of the fund is dedicated to this category or space.
Excellent. I think this is a very nice visualization of your mind map and how you look at the stocks when you build up a large and mid cap portfolio, and for that matter, most of your portfolios. Thank you, Chinu, for sharing this in such a visually appealing manner. You answered this in the beginning of the call, but if you want to change your answer or add anything to it, so I remember when we asked you about sectors in general, you mentioned two. Broadly speaking, you mentioned high conviction in auto and high conviction in capital goods. But the question is, could you highlight maybe two or three or four sectors or themes where you see the strongest combination of visibility in earnings, competitive advantage, and reasonable valuations?
No, no, fair, fair. So I think, Rajat, the earlier question when we spoke about it was more about earnings, which was
Hmm.
quite near term in nature, where we are
Yeah.
seeing near terms earning upgrade, etc. But to this question, what we are on, I'll talk about the pillars we call them. So
Okay.
these are the pillars. Their proportion or order will change every quarter. Somebody can become first and somebody can become fourth. But these are one, two, three, four. Today, when I'm putting them, they are not in any order. But just to tell you, it's financialization. We believe it's a very strong pillar for India. There's still a lot of scope for financial penetration, and technology is doing a very heartful job in ensuring that. Today, the data access that you have on click of a button, both for asking for a loan as well as assessing whether you are worthy of that loan,
Hmm.
both have become extremely great, and this is visible in the kind of asset quality output you're getting. We are now seeing, I think, almost 3 or 4 years of excellent loan growth that we've seen, at least in the retail oriented sectors. And second, still the asset qualities have been managed. So I would give this credit both to strong management policies of our financial institution under the oversight of RBI, of course, as well as technology. Will take a large share of this credit because this is something which is giving the management the bandwidth to symmetricize their processes. So this is one pillar of financialization. The second pillar that we find is encouraging is manufacturing and infrastructure. Broadly, I must say manufacturing, and this is coming from government initiatives. So this is one sector which is being driven by a lot of measures the government is taking. Had that not been the case, I don't think it could have stood the ground. But what we are saying is government's incentives for local manufacturing. It started from the time of Make in India and Atmanirbhar Bharat, but today we are coming actually a long way. Several of your supply chains in defense, power, engineering, you will see that they earlier used to be dependent on import. So a lot of imports used to come in the country. Today, as we are talking, these are being replaced by domestic manufacturing. So our
Yeah.
domestic supply chains have already become strong in this area. And the idea of philosophy is that once we start catering to domestic market, these companies can become strong enough to start exporting and become part of export supply chains. So this is something even today it's small because a lot of small cap companies come in this category. But
Yeah.
the interesting thing is I'll have in my portfolio at least two, three names where I've seen the entire journey. They being small cap to mid cap to now becoming large cap. So a lot of companies are following this progression in this category. Coming to the third category, consumption, and I think we always call it the evergreen category. In India, if you're talking about investment, you cannot leave consumption away. A lot of things are changing in consumption. The idea is to say that India is moving from penetration journey to premiumization to now convenience orientation. So this is this entire journey of decades that we've seen. And today, Indian consumer has started paying for convenience, which is like a different level altogether because Indian consumer is one of the most value conscious consumer in the world. So that change has happened in consumption, and we see several companies who are poised to take advantage of this. So we like companies in this category. And the last pillar that you'll see, digitization and platform. Now, this is something which is not different. It's actually a part of this first and third pillar. Several companies in financial space and in consumption space are using this digitalization. So, your fintech companies, then you have all these new age companies in consumption which are coming up. And we find this a very interesting lever. Reason being, most of the time, when a company grows in scale, the kind of operating leverage that you will get will be limited.
Yeah.
You have to increase your distribution, your salespeople, etc. However, for these digital companies, when scale comes, the investment does not grow proportionately. So, with scale, the kind of operating leverage that you can start getting in is something very interesting. So, that is why we call it like the fourth pillar for our investments.
And I think the fourth pillar, very interestingly, can actually have an overlay on the first three pillars as well. Am I right, Chinu? Because you'll
Yes,
find
very true.
examples of fintechs and digital platforms across, one, two, as well as on three. So that's kind of a common thread which runs across the three main themes that you talked about. Very interesting, and thank you so much for summarizing this. This goes long and much more beyond the few sectors that you talked about initially, because here you're talking about themes which will take India to the next level. Quickly moving on to the other two funds. On the mid cap fund, I think we've got some questions on the chat also. People are complimenting you on the performance and everything. Thank you so much on behalf of Chinu. And I think one question which is probably on the mid cap sector and probably how you are managing the fund is on the valuation part. So obviously we all know that there's a difference between an expensive but good company and an expensive stock. So the margin of safety, the level of discount, which perceived discount with the cover the stock is giving, the intrinsic value of the stock, all those things I'm sure are measured by you and the analyst team. Chinu, could you give us an example of how your portfolio construction helps manage the higher volatility associated with mid caps? So you can talk about position sizing, liquidity, downside risk, etc. etc.
Yeah. So Rajat, I'll answer both parts of your
Yeah.
question. The first part, it's a very interesting debate of how a
Mm.
company is expensive and good, and what you said other way around. The key thing is in our minds, the biggest mistake we can do is anchoring a valuation to a
Yeah.
company. There is no company for which a valuation band is fixed. I
Mm.
think it has to be taken in cognizance with the growth and durability of growth, as in the
Mm.
period where you can see the visibility of that growth.
Sure.
Why I said is many times you will find companies giving you 30-40% growth in 1 year, but when I'm coming to next year's outlook, I'm still able to pen it down to 15%. So then you're not talking of extremely high growth for a reasonable period of time. So what we are saying is, in case you are able to get a company where you see good earnings growth and for a reasonable period of at least 2 to 3 year visibility, that is
Mm.
the time that you can give it higher valuation. So pegging valuation with growth and durability of growth. So this is that important metric.
Yeah.
Apart from that, I think that is one of the reasons we've never been able to have these FMCG companies, because they are trading at now 40 times, earlier 50
High
times.
valuations. Yeah.
But the earnings CAGR you are still talking there is what, high single digit to early double digits. So then you call them expensive. So it's
Mm.
very important to understand that where your earnings growth and durability of earnings is there versus your valuation. I think this is the metric kind we move
Mm.
together, and this is how we pick companies, right? And moving to second part, what you said, how we manage risk in mid cap. I thought what better example than to just show. This is our current positioning of mid cap, and this is a question that we deal with every day. How do we manage? So I think first thing is we say that it has to be a good mix of conviction and risk
Mm.
management. You
Mm.
will see here what I was saying, that even the best of our conviction ideas, we've kept it within 5%, and that
Yeah.
is a mental tag. It's not a rule. It might become 5.2, 5.3
Mm.
wherever, but
Mm.
usually we kind of feel that this is enough risk that a portfolio can bear, and at the same time our convictions are coming out. So it's not that we have a tail of 2% holding. If we have confidence, we'll show that. Another thing you will observe is how we have a mix of sectors and the three category approach, which I spoke about. So
Yeah.
something like a federal bank, when we picked it up, it was in the turnaround category. The new management had come in. They were changing the company. And today, as we are talking about it, they have progressed through transition for some part of it, and they are already in the stability bucket. Lenskart will be again in the third category when they came. Today, they are in the high growth category. Nika, high growth category today. Again, when they entered the portfolio, it was in third category. So just trying to tell you today, when the portfolio you look at, it's a mix of some high growth companies, GT&D high growth company, but then you have somebody like an MMFS, the last category, which is still a turnaround story. So you're trying to balance the three categories so that your portfolio is not overly present on the stable category or not overly present on the growth or even the turnaround. So this is the kind of mix you keep, and this is the kind of composition also that we want, so that the portfolio gives you conviction as well as risk management.
These are some examples that you've taken, Chinu. I also see a very healthy mix of companies which were listed some time ago and some new IPOs which have come in. So I think that also tells us that we are constantly on the lookout for new ideas and new companies which can add value and growth to the portfolio. Yeah.
Yes, yes.
Thank you so much. Okay, Chinu, we come to your last fund, and this again is a favorite amongst a lot of our partners and investors. This is the hybrid. This is the equity savings fund, which you've been managing in a very particular way, and I believe it's slightly differentiated from the competitors in the fund management space and the industry. So let's talk about this last few questions, and then I'll go to some questions from our audience. So with equity valuation still generating debate, like we saw, and investors looking for maybe a smoother journey. Where do you see the role of equity savings funds in an overall investor portfolio? That's a very generic question, which a lot of partners would want to hear your views on. And secondly, and this is the last question which I have, where you can show us data, and then we'll go on to the audience. Uh, could you simplify for a lot of our partners on how the combination of pure equity, fixed income, and the arbitrage positions that you take in the portfolio, it works within an equity saving strategy? So maybe you can talk about some trends, how you've been following the breakup, or have you been putting the allocations between the three? Yeah.
Okay, sure. So, first of all, to give an idea of equity savings, where does it fit in?
Hmm.
So, this is equity savings category as such, and equity savings index, which we are showing.
Yeah.
The idea is to tell that this equity savings fund is for people who are looking for a category somewhere between debt and equity. So, it's not like a BAF. A BAF will have a very high equity composition, but here the equity range is fixed in a lower proportion, and somebody is getting to taste or test the equity market without having to worry too much of the volatility, because your equity exposure in these schemes is usually between 30 to 40%. So that is the kind of range. So you can almost say it is like one third the volatility of your equity schemes. With that, people can participate. If I have to talk about portfolio composition, where it can fit in, if suppose somebody wants a debt allocation, you're creating a portfolio for your investor where you're saying that 20-30% allocation is in debt, remaining is in equity. Now within that debt allocation, maybe a 10% allocation can go to something like this, which is not extremely high risk, and little bit, in terms of return, it's like an add-on to what you're getting from the debt. So maybe a 10% kind of allocation can be in this space, which is a balance between equity and debt.
Sure,
So this
sure.
is how I see this, like an interesting category
Lovely.
for the investors. And your next question, which you said, how it generates return, if people just want to
And
understand
your
in
breakup, how do you manage the three assets?
right,
Yeah.
right. So the first portion in equity savings is generally the unhedged equity,
Hmm.
which is 15 to 40% allowed by regulation. It used to be 45%
Yeah.
some time back, and now they are soon progressing. I think in a month or two, it will be 40% capped. So
Hmm.
15 to 40% we'll keep in equity. If you have to talk about HSBC equity savings, we keep it usually in the range of 32 to 38%. This
That's
is
nice.
where we've managed our equity portion.
Yeah.
Next is the arbitrage portion, which takes it up to 65% and above, and
Hmm.
which together makes the equity allocation above 65%, because that is how you get the equity
Taxation.
taxation.
Yeah.
And last portion is the debt. Today in our schemes, debt is around 25%, and 75% is between unhedged and hedged equity. And unhedged active equity in the fund today is around 36%. And just to conclude, Rajat, how we have managed HSBC equity savings is building the equity portion with only conviction bets. So here we are not trying to have all the sectors or all the stocks in a benchmark. What we say is if we have conviction on an idea, only then it will come in equity savings. If there's less conviction, it better be out of equity savings. Because
Hmm.
either ways, you have only 30 to 40% allocation. So why keep so many ideas? So I think that is how we've tried to manage equity savings. Also, we've given it a large cap flavor
Hmm.
to manage the risk profile. Today, you will see 65-70% allocation within equity is towards large caps, 25% towards mid cap, and 10% towards small cap. So this is
Yeah.
how the composition of equity is within equity savings.
Excellent, excellent. A lot of questions on this fund because this fund has been, there in the radar for a lot of our partners and investors, and a lot of investors have benefited from it by investing in it over the last 3 years. They've not been easy. So thank you, Chinu, for explaining to everybody a couple of things where about our breakup between asset classes, how do you manage the hedged and unhedged equity, and also talking about the stock level, where we are not going out and buying the market, but we are sticking to some very high conviction ideas. I think that is also very, very critical for our partners to into your mind and brain. I think this was very, very well appreciated. Lots of compliments coming for you and the overall webinar from our audience members. Thank you, everyone, once again, and we will come back to you again next month with a new portfolio manager and new perspective, and hopefully a better and smiling market. Thank you, Chinu, once again, and thank you all for joining the
Thanks,
webinar.
Rajat. Thank you, everyone.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.